Don't go. Where are you going? Where's everybody going? We have now a guest which is the most active Series A investor in Europe. Ahí os dejo eso. So please take a seat, relax. We're going to start in a minute. For those that are coming in, there's plenty of spaces at the front. Don't be shy. I promise I won't make any direct questions, just rhetorical ones for anybody to ask if they answer if they want. Okay, we're going to talk now about road to exit. And if early stage venture is about asking what if it works, late stage venture is asking what is it working? And the latter requires deep expertise in the financial evaluation of businesses. It seems companies are staying private longer than ever now, resulting in a smaller number of actual IPOs. Well, to talk about the road to exit, answer all your questions, the ones you may have in your head, everything is going to be solved today. Because as I was saying, we have with us the Senior VP of the largest and most competitive IPO market in the world, which is NASDAQ. Of course, his name is Adam Kostial, and he's going to be interviewed by the principal at Bounderton, Lara Connell. So let's welcome Adam and Laura. Welcome.
Great music.
Yeah, thanks for that.
Great thing.
Hi, everyone. Thanks very much for being here. I'm excited for this discussion. So maybe I'll just introduce myself a little bit, although you've already heard a little bit about me. I'm one of the principal investors at Bounderton Capital, so based in London, but we're one of the most active, in fact, the most active Series A investor in Europe to date. I am both involved on the early stage, and I also do much of our later stage investing through our secondary fund. And we'll talk a little bit about that today. I'll hand over to you, Adam.
Thank you. So this is not an interview, this is a conversation.
Yeah.
So I'm just as curious to hear from you in terms of how you work with late-stage companies. I'm responsible for our listing market in Europe, which includes our Nordic markets. We own 7 exchanges in the Nordics, Stockholm, Copenhagen, Helsinki, our largest ones. We've had 40 IPOs so far this year, last year 83, so it's a very active market for growth companies in the smaller size. But we're, of course, also supporting European companies listed in the US. And there are quite a few great examples over the last few years how they've used the US markets. And the US markets has been very hot this last few times, but it's getting a bit colder. So, it's a very interesting time to talk about the IPO markets.
Yeah, and perhaps we can kick off there. Obviously, it's been an incredibly busy 12 months.
Yes.
And some very interesting and at times controversial listings. You know, what do you think some of the key takeaways are, and what are your thoughts about how the last 12 months have played out?
Yeah, well, first of all, I think it's a crazy environment that we live in now with these low interest rate environment. And in Sweden, we have negative interest rates, which means that everybody's looking for return of investment, and both in the private landscape and in the public landscape. So I think what we're seeing is we've never seen so much money in the private landscape as we see now. And there's a lot of maturity in that money in terms of helping companies stay private and mature longer outside the public markets. If you reverse the tape back to 2000, companies were coming much more earlier to the exchange, with the negative side that their businesses weren't as mature. Yeah. Now the challenge here is that there's only so much the private market can do for a company when they reach a certain stage. At a certain point, the public market has additional values that it can bring to this company, and therefore you're seeing now more and more companies come to market. Of course, the valuations have been very good. But it's not been very easy to transition these valuations in the private market to the public market. So I think we will continue to see a strong IPO market because interest rates are relatively favorable for the equity market. But doing that transition will be much more delicate than it has been before, especially from a valuation point of view.
Yeah, it's so interesting. So if you think back to the first couple of decades in tech, you had the likes of Intel coming to market within 2 years. Amazon, I think, was 3.
Apple was a $50 million IPO.
Yeah, right.
You don't do these anymore.
No, you don't. And so, one of the other trends that we've seen is this debate around IPO versus direct listings.
Yes.
And how do you think about that and the evolution of those two things in tandem?
Well, I think the direct listing is a trend that we're seeing. I think it's here to stay. It's not for everyone. I think it is for a company that's well-funded, that is well-established, has a very strong brand, and can carry the weight of moving into the public markets with the direct listing. What the direct listing is basically you're selling off existing shares to new shareholders without raising new money. So basically you're transitioning into the public markets in a very smooth and efficient way.
And non-dilutive.
And not dilutive.
Yeah.
Now, the interesting thing here is that the reason why many companies have come to market is to increase their brand awareness, to raise money, and to create liquidity for existing shareholders. But it's not the end game. So at the end of the day, I think even the banks, which were very against the direct listing because their role gets minimized, are now very favorable to it because it's less of a shock to the market to transition to that. But again, it's not for everyone. Spotify did it. We had, oh God, now I forget the other company that just did it. But it's Slack. Slack is the company that did it. And Airbnb is discussing it. It's in the papers. So I think it's a trend that will stay, but it's not for everyone.
Yeah. I think the other thing that you and I have spoken about, one of the interesting results of this average time to exit almost doubling really over the last 10 years is that we've seen this development around the secondary market, so an increasingly liquid secondary market. And in the US now, that's a very established market. And so when I talk about secondary, really, we're talking about secondary or liquidity, so an ability to sell shares privately before an exit for early investors, founders, early employees. And that's something we're seeing more and more of in the European market as the market matures.
Is it fair to say that it was a bit of a taboo topic before?
Yeah, absolutely.
Because it was considered to be, you're not keeping the skin in the game. You are taking away. But in reality, what is happening is that this phenomenon of staying private longer and the access to capital in the private environment has created a very frustrating situation because you have a lot of employees that it's their first job.
Yeah. Huge cash pay cuts, often.
Exactly.
Yep.
Their value that they have is in the shares. As the company grows and continues to raise capital, they need to buy a car, they need to buy a house, they need to do something, and the only way to create that value is to create liquidity for the employees.
Yep.
So you're actually taking away pressure from the pressure cooker.
Yeah, absolutely.
So that you then go back to work, but everybody has gotten some pressure off. Isn't that a fair way to look at it?
Yeah, I think that's absolutely the right way to categorize it. And just on the kind of first point about this kind of signaling mechanism, or the fact that it can be a negative signal for companies to look for this secondary liquidity, that can be true. And so I think timing for the secondary and framing the reason for secondary to investors is absolutely critical to avoid that kind of signaling mechanism.
So you as Balderton, you're considered, you are the leading Series A investor in Europe. You've now launched a secondary fund.
Yeah.
So can you explain to me a bit how that secondary fund works? Because just to give you a balance, in the US, we run something called NASDAQ Private Market, which is a marketplace for secondaries, for liquidity of late-stage companies. We've done close to 50 this year. We did 80 last year. We probably have 30 more this year. And we're seeing an increased appetite in Europe. But what has been missing is active funds that are willing to buy these secondary shares. And that is what you have established now. Yeah,
absolutely. So we launched this fund last October, and we were the first fund to really focus exclusively on direct secondary, so buying these shares off the shareholders I mentioned. And I think the reason that hadn't occurred in Europe before is simply a question of the maturity of the market. So the way we think about it, and the reason we're so excited about this fund and Europe generally, is that this is a strategy that would not have worked as well 5 years ago. But the sheer number of interesting growth stage businesses coming to market in Europe is astronomical now compared to, as I said, what it would have been 5 years ago. So our logic was, we can see that there's an increasing need for liquidity, this pain point that people need to find a way of taking a bit of skin out of the game. for various reasons, partly because of the fact the average time to exit has doubled, but the size of that liquidity pool has also increased significantly because of the number of growth companies that we're seeing in Europe. And so what we set out to do with a $145 million fund is to really directly address that by buying these shares off early employees, founders, and early investors.
Correct.
So,
and how many deals have you done now this year?
It's been a very busy year. We've done 8 deals.
Because it's only 1 year since you launched the fund.
Yeah, exactly. It's been 12 months, but we've done 8 deals to date. And what I think is hugely excited about is that as the number of growth stage companies continues to increase and come to market, that pool of opportunity for us to be helpful in situations continues to increase. So it's been a very exciting year, yeah.
I think the topic is maturity, because I think it's also an education thing.
Yes.
Educating the entrepreneurs that this is something, it's a tool to support your scaling, as you're scaling.
Absolutely.
Because it is also a retention mechanism.
Absolutely, and it's also critical in the competition for talent.
Yes.
I think one thing that we've seen a lot more of is CEOs recognizing that structuring employee liquidity such that people it makes tangible their equity gains is absolutely critical from a retention perspective. And so if you have 2 companies, one of which can offer that as a tool, offer that liquidity, and one that doesn't, all other things being equal, top talent will find that former opportunity a more compelling one. And so, particularly as the competition for talent hots up in Europe, that's something that I think more and more companies will have to kind of engage with.
So have you taken away one of my sales arguments? That's what we used to argue. That was the benefit of the IPO.
Right,
is that you can create liquidity for employees, you become a more attractive employer.
Yeah, and that remains true. That remains absolutely true.
I think it's a different dynamic.
Yeah,
but
absolutely.
it is a component of that, which is very important.
Yeah, I mean, I think the way we frame it is this is partial liquidity. I think it's also really important for founders to have access to some of that partial liquidity sometimes. If I think about the huge pressure that founders are under that we work with, brilliant people who, as we said, have seen more and more of their wealth tied up in equity.
Yes.
At some point, your kind of ability to take more risk becomes impacted. And it's a kind of risk aversion is a real thing. More of your wealth is tied up in it's a liquid asset. Actually, your ability to take a tiny bit off the table makes a huge difference to your risk appetite. So we find it's a really good mechanism for realigning founder incentives and, frankly, appetite for their own business at a point at which it's really important they carry on with the mission.
It's not something you do the first year. It's not something you do the second year. But it's something you do when you've probably reached a later stage of financing. And I remember listening to the founder of Supercell, and he always described when they did their liquidity, it was a very difficult moment because you're giving up a certain amount of value because you feel that you're building a castle and you're selling it at halfway price. But what he said, it was the best investment he did to create liquidity for himself and for his fellow founders, but also the employees, because they could then go back with less pressure and just focus on building what Supercell is today.
100%.
And I think, I encourage founders and employees, founders and entrepreneurs, and also owners of their companies to talk to Balderton about the secondary, because it's an educational process. It's about understanding when is the right time to do it, and when the right time is there, how do you do it?
Yeah.
Because I think it's an educational process.
Absolutely.
That you can provide a lot of value to.
Yeah, and I think and that's part of the things the initiatives that you've worked on as a business is really facilitating those transactions and creating the marketplace that allows them to happen in a painless way. I think rightly, historically, these transactions have been slightly opaque and a lack of transparency around valuation, around the third parties that are entering the cap table when they're buying this direct secondary. And so understandably, people have always historically been a bit more reticent about it. But over time, as this secondary transaction market professionalizes and the market matures, people understand that these things can happen in quite a painless way.
Yes.
They need not be incredibly high friction.
So hopefully you will get a few more mails in your LinkedIn box.
Absolutely.
But one thing that we always say is that the holy grail is the IPO.
Right.
And my question to you, is this really true? Is this the sense that you, from a VC point of view, do you want to, when you go and invest in a company, do you strive to make this an IPO-able company? That doesn't mean that it's going to IPO, but the ambition should be there, the ambition level should be there, and then at least when you have the IPO as an option, you have one more option on the table. And the best example of that is iSettle.
Yeah, absolutely.
So it was a very frustrating moment for me as an exchange, because I thought I was going to ring the bell with iSettle on a certain date. All the VCs were there. Everybody was, we were educating them, we're training them. And then last minute, PayPal bought the company. And I don't think that transaction would have happened unless iSettle would have pushed the IPO track button. Because they really told the market that we're ready to take the next step in our ownership structure. And I think PayPal woke up and realized, wait, this train is about to leave the station. And if we don't do anything now, then we're going to lose this opportunity. And I think that's the way companies should grow their businesses, is to say, listen, not say I'm never going to IPO, but really understand how to gear up step by step, not from day one, as you mature your business. What are the additional layers that I have to take on and when to be an IPO business? Because then you have one more negotiation tool when you decide that you need to change your ownership structure. Would you agree? Is that something that you discuss with your companies?
Well, I think the word that you hit on, which is absolutely critical, is this idea of ambition. And so when we invest in founders and winning teams, what we're looking for is the scale of ambition that would, to build kind of the next leader in whatever category they're active in. We're agnostic in principle about exactly what that exit looks like. Obviously, everyone likes the kind of the IPO. It's a very public endorsement of things that have gone well, but there are lots of absolutely fantastic routes to exit that aren't necessarily an IPO. And so in the end, from our perspective, we know full well that the best we can do is support them, as you say, ensure that if it is something that they want to do, which it should always be part of the game plan, right, as a company matures, it's one of the things that you can consider, that we're helping them structure the route to IPO appropriately. That means hiring the team, the CFO, so the canonical advice here when preparing for an IPO is you've got to hire the right team, someone who focuses on getting the game plan in place, and then the two other elements are, in terms of timing, understanding what the right volume is. Where do you need to get to in terms of creating a credible story about the size of your market, and secondly, having sufficient predictability in your revenues. And when we think about predictability, it's really being able to clearly understand the key levers. So if something's happening in this bit of your business, you know exactly how it impacts your contribution margin or bottom line or whatever it is. So having that predictability of revenue over a couple of quarters or a 12-month basis is absolutely critical.
I agree entirely that the message that we typically tell companies is that it's not only about growth, it's not only about profit, it's about the predictability in what you're in your business. If you're able to deliver on that predictability, then you're building confidence with the investors. And there are so many investors out there looking for all different types of profiles. So whether it's growth, whether it's profitability, but ultimately they're going to build a trust with you as a manager or as a CEO that you are delivering on the goals that you're predicting.
Absolutely.
So, and the other thing which I would argue is that even though iSettle was acquired by PayPal, PayPal listed on NASDAQ, it is interesting to see that companies that are listed have one more mechanism to grow their business, and that's through acquisitions.
Absolutely.
And I think, keep in mind, we're always arguing that Facebook and Google are buying all the startups, but they were a startup at one point themselves. So, the reality is that it is a platform for growth. And once you aim to get there, hopefully, managing the secondary market is a tool to reach that level of maturity. So I think our time is up. But I encourage you to reach out to Laura and to Balderton, because I think the secondary fund is very exciting. It's a reflection of the maturity of what's happening in Europe. And if you're interested in IPOs, whether you're a startup or you're early stage or late stage, we're always willing to take a discussion. So thank you very much.
Thank you. Thanks, guys.